On July 23, 2019, Kimberly-Clark Corporation reported second quarter earnings for the period ending June 30, 2019. This video provides an update on the company's dividend safety using its most recent operating results. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. With that out of the way, let's dig into Kimberly-Clark's dividend safety. To begin, let's talk about Kimberly-Clark's business model. Kimberly-Clark is a global consumer products company that operates in 175 countries around the world. The company's key brands include Huggies, Pull-Ups, Kleenex, Scott, and Cottonelle. Kimberly-Clark has a market capitalization of $46 billion, with annual revenues in excess of $18 billion. Kimberly-Clark is one of the world's most popular dividend growth stocks. The company's current dividend yield is nearly 3.1%. Moreover, Kimberly-Clark is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 47 consecutive years. Because of this, Kimberly-Clark qualifies to be a member of the Dividend Aristocrats, an exclusive group of dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, Kimberly-Clark is just 3 years away from becoming a member of the Dividend Kings Index, a group of even more exclusive stocks with 50-plus years of dividend increases. Looking ahead, investors interested in owning Kimberly-Clark stock will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss Kimberly-Clark's dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Kimberly-Clark's dividend safety in the context of the company's current earnings. In the second quarter of fiscal 2019, Kimberly-Clark generated adjusted earnings per share of $1.67, which compared favorably to the $1.59 of adjusted earnings per share in the same period a year ago. For context, Kimberly-Clark currently pays a quarterly dividend of $1.03 per share, which implies a payout ratio of 62% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Kimberly-Clark generated $3.33 of adjusted earnings per share in the first half of fiscal 2019. The company distributed $2.03 of common share dividends during the same time period for a dividend payout ratio of 61% in the full fiscal year. Using earnings, Kimberly-Clark's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Kimberly-Clark's current dividend payment to its free cash flow. Kimberly-Clark generated $609 million of cash flow from operating activities in the second quarter of fiscal 2019 and spent $253 million on capital expenditures during the same time period for free cash flow of approximately $356 million. The company distributed $355 million of common share dividends during the same time period for a free cash flow dividend payout ratio of nearly 100%. Looking out over a longer time horizon, the company's payout ratio is significantly higher. Kimberly-Clark generated $926 million of cash flow from operating activities in the first half of fiscal 2019 and spent $569 million on capital expenditures for free cash flow of approximately $357 million. The company distributed $700 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 196%. Using free cash flow, Kimberly-Clark's dividend could be at risk for a dividend cut. We encourage investors to monitor this situation closely moving forward. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Kimberly-Clark's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Kimberly-Clark's performance during this time period is shown here. Despite a decline in 2008, Kimberly-Clark produced a 6.4% overall increase in adjusted earnings per share during the last recession. The company did not make a new high in adjusted earnings per share until 2013. More importantly, though, the company's earnings still covered its dividend payment, and Kimberly-Clark continued its streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Kimberly-Clark's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest rate would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the second quarter of fiscal 2019, Kimberly-Clark had $8 billion of total debt outstanding. The company generated $67 million in interest expense in the most recent quarter for a weighted average interest rate of 3.4%. Normally, we include an interest rate stress test in these analyses that shows how much Kimberly-Clark's weighted average interest rate would have to increase before its dividend would no longer be covered by free cash flow. However, since Kimberly-Clark's dividend is already not covered by free cash flow, we have excluded the analysis from this video. Looking at over a longer time horizon, our conclusion is the same. For the first half of fiscal 2019, Kimberly-Clark generated $132 million in interest expense for a weighted average interest rate of 3.3%. Again, we would normally include an interest rate stress test in these analyses that shows how much Kimberly-Clark's weighted average interest rate would have to increase before its dividend would no longer be covered by free cash flow. Unfortunately, Kimberly-Clark's dividend is already not covered by free cash flow, so we have excluded the stress test from this video. We reiterate that investors should monitor this trend closely moving forward. Thank you for watching today's video, which performed a deep dive on Kimberly-Clark's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.